Today, we embark on an enlightening journey through the intricacies of investing. In this video, we'll uncover two powerful concepts of stock picking frameworks and investor edges. An investor needs to have a framework for evaluating different quality of stocks so that they can be valued appropriately. For ease of investors, we will create 3 such frameworks in this video. Next, it is very important for you as an investor to know how you can gain an edge over other investors. We will be talking of 3 types of investor edges in this video and how you can attain them. When combined, both these powerful concepts can have a transformative effect on your portfolio. Let us start with helping you categorize the 3 types of stocks so that you have a framework for valuing stocks appropriately. Investors typically look at the price-earning ratio or PE ratio of companies and come to a conclusion as to the cheapness or expensiveness of the stock. There is no yardstick based on which an investor can decide that a 15 PE stock is cheap or a 20 PE stock is expensive. After all, it all depends on the company's growth prospects, the quality of its management, the quality of the business, the moat or the competitive advantage that the company enjoys, etc., etc. So then how do investors figure out how to value different types of companies? In an earlier video, we have covered the 3 types of companies, which is the value stock, the long-term compounder, and growth at a reasonable price. To keep things simple, we will just look at these 3 categories, though I would like to tell you that there are many more. So if you are looking for value stocks, you would typically find them in commodity sectors like in coal, in oil, in steel, etc. These companies typically deserve single-digit PE multiples. Whereas if you look at growth at a reasonable price, these companies are growing in double digits, but their management or their moat is not of the highest caliber. As a rule of thumb, these companies can be valued at roughly 1.5 times the growth. So if a company is growing at 15%, a fair PE could be somewhere around 22 times. For the highest quality companies like Asian Paints or Titan, the PEs of even 50 or 60 could be reasonable. However, let me caution you that this does not mean that a good quality company with a high growth rate can be valued at a 50 or a 60 PE. It will have to be done on a case-to-case basis by evaluating the cash flows, the total addressable market of the company, or the size of the opportunity that the company has, its competitive advantages, the moat or special advantages that this company has over its competitors, etc., etc. But as a rule of thumb, these companies can be valued higher than both the value stocks as well as the growth at a reasonable price stocks. As we conclude our exploration of valuation frameworks, it's crucial to understand how to harness these insights effectively. In the upcoming segment, we'll delve into the practical application of investor edges for different types of stocks, providing you with a detailed roadmap to maximize your returns. An edge is simply an advantage that an investor has over all others. If investors do not have an edge over their fellow investors, then there is no way that they will be able to earn higher returns than their colleagues. Now, there are 3 types of edges which are available in markets. The first is informational, where an investor has an information which other investors do not have. For value stocks, an informational edge is understanding the industry's supply and demand dynamics. While for quality at a reasonable price type of stocks, an informational edge would be understanding the depth of a company's moat and its competitive positioning. And for long-term compounders, an informational edge is understanding the total addressable market as a company is already dominant in the industry. The second type of edge is analytical, where you can analyze the company's balance sheet and profit and loss, the moat or the total addressable market, or the company's competitors and its vertical in great detail. An analytical edge for investors investing in value stocks would be understanding the capital cycle, or the balance sheet, which can provide an edge over other investors. Similarly, for quality at a reasonable price type of stocks, an analytical edge for an investor could be understanding factors like industry consolidation or formalization. And for long-term compounders, insights into forays into adjacent industries and return on incremental capital employed are critical. The third type of edge is basically emotional. This edge is related to the biases that many individuals have. For instance, hindsight bias is a bias whereby investors feel that they knew already what would happen to the market. Investors in value stock should show the behavioral discipline to sell on achieving fair value, while for growth at a reasonable price type of stocks, investors need to be patient and evaluate the potential for the company to become a long-term compounder. While for long-term compounders, patience is key, as these stocks can turn out to be multi-baggers if held for the very long term. As we conclude our exploration, you gained valuable insights into both valuation frameworks and investor edges, empowering you to navigate the complexities of the stock market with confidence and finesse. By categorizing stocks based on quality, growth, and value, and understanding the various edges available to investors, you are well equipped to make informed decisions tailored to each category of stock. Remember, success in investing lies not only in understanding the fundamentals, but also in leveraging strategic edges to gain a competitive advantage. Happy investing!